Fair value gap is one of the most powerful tools used by smart money traders, and its popularity is absolutely justified. But the truth is, most traders fail because they don't understand why fair value gap forms, how to identify valid ones, or how to trade them properly. Fair value gap forms when price is delivered aggressively and inefficiently, usually during institutional moves. This creates an imbalance between buyers and sellers and leaves behind areas where price didn't trade fairly. And that's exactly what gives us an edge. Welcome to Graph Insight. In this video, you'll learn what fair value gap really is and the true reason behind its formation, how to identify fair value gap correctly, and how to filter high-quality fair value gaps from low-probability ones. And as a bonus at the end, I'll show you several trading techniques I personally use with fair value gaps. Let's start by defining how fair value gap actually looks on a chart. For that, take a look at this three-candle sequence. Here we see three strong candles moving aggressively in one direction. Notice something important. The wick of the first candle does not overlap with the wick of the third candle. That price gap between the high of the first candle and the low of the third candle defines the fair value gap. This structure forms because of a strong imbalance between buyers and sellers. Price moves too fast, leaving behind an inefficient area where liquidity was skipped, which is why price often struggles to move back through this zone immediately. The same concept applies in the opposite direction for a bearish fair value gap. In this case, the low of the first candle and the high of the third candle create the boundaries of a bearish fair value gap. Again, this reflects aggressive price delivery and a clear imbalance on the sell side. So why do we care about fair value gaps? Our goal is to position buy or sell orders inside the fair value gap zone. Price often returns to these areas to rebalance the inefficiency and frequently reacts from them, creating high-quality trade opportunities. This is exactly why fair value gap is such a powerful concept when used correctly. Now that you understand the basics, let's talk about what makes a fair value gap valid. The most important rule is whether the fair value gap is unmitigated. If price has already returned into the fair value gap, the probability of a clean reaction drops significantly. In this example, we see a bullish fair value gap, but the very next candle leaves a wick inside the fair value gap zone. This tells us that the imbalance has already been partially mitigated, meaning a deeper rebalance is less likely, and this fair value gap is no longer considered valid. The next important characteristic is a less common four-candle fair value gap. This type of fair value gap appears when the first candle in the sequence is an inside bar relative to a previous mother bar. In this case, we must include the mother bar in our candle structure. That means the boundary of the fair value gap is defined by the wick of the mother bar, not the wick of the inside bar. If we ignore the mother bar and draw the fair value gap using only the inside bar, the fair value gap becomes incorrect and invalid. The same logic applies to bearish fair value gaps as well. Another clear sign of an invalid fair value gap is when price breaks through the zone and a candle closes beyond it. In this example, we see a bullish fair value gap followed by a retracement back into the fair value gap zone. However, during this retracement, the candle closes below the fair value gap. This tells us that the imbalance has been fully absorbed by the market, which makes this fair value gap invalid. Another key factor is when multiple fair value gaps are present and we need to decide which ones matter. To do this, we identify the major high and major low of the most recent impulsive move and apply the Fibonacci tool to that range. This divides the move into two zones, the premium zone and the discount zone. The logic is simple. The discount zone represents lower prices within the range, where buy-side setups make the most sense. The premium zone represents higher prices within the range, where sell-side setups make the most sense. That's why we trade bullish fair value gaps only in the discount zone and bearish fair value gaps only in the premium zone. Another important rule is that the fair value gap should be aligned with the trend. If the market structure is bullish, we focus only on bullish fair value gaps. If the structure is bearish, we focus only on bearish fair value gaps. The probability becomes even higher when the fair value gap forms immediately after a break of structure. This strongly increases the likelihood of a clean retracement into the fair value gap and a strong reaction in the direction of the trend. Another sign of a high-quality fair value gap is the absence of nearby key levels. On this chart, we see a bullish fair value gap, but there is a strong resistance zone located directly above it. In this situation, the resistance may be stronger than the fair value gap itself. As a result, when price retraces into the fair value gap, instead of reacting and moving higher, price is more likely to break through the fair value gap and continue in the opposite direction. This is why fair value gaps work best when there are no major support or resistance levels blocking the move. Now that you understand what criteria make a fair value gap valid, let's move on to practical trading strategies. These strategies show how to apply fair value gaps in real market conditions using confirmation, market structure, and proper execution logic. The first strategy, on this chart, we see a bearish fair value gap formed on the 4-hour time frame. The higher time frame fair value gap defines our main area of interest and gives us directional bias. Instead of entering directly on the 4-hour chart, I switch to one time frame lower, which is the 1-hour time frame. On the 1-hour chart, I look for a new fair value gap that forms inside the boundaries of the 4-hour fair value gap. This lower time frame fair value gap acts as confirmation, showing that imbalance is still respected within the higher time frame zone. In other words, the higher time frame gives us direction, and the lower time frame gives us precision. Once price performs a retracement into the 1-hour fair value gap, we open a short position. The stop loss is placed at the upper boundary of the fair value gap, and the take profit is set at twice the stop loss distance. This multi-time frame approach helps us avoid false fair value gaps, filter low-quality setups, and enter trades more accurately with better risk to reward. Now let's move on to the second strategy. This strategy is more advanced and is based on a market structure shift. On this chart, we initially observe a bullish market structure with consecutive bullish breaks of structure. This tells us that the market is trending higher and that buying pressure is dominant. At some point, the structure changes. We see a change of character as price moves below the previous major low. This signals that the bullish structure has failed and that bearish pressure is entering the market. Now we look for a bearish fair value gap that forms during the last impulsive move to the downside. This fair value gap represents fresh imbalance created after the market has already changed direction. Once price retraces back into this fair value gap, we open a short position. The stop loss is placed at the upper boundary of the fair value gap, and the take profit is set at twice the stop loss distance. This strategy allows us to trade in alignment with market structure instead of guessing reversals or entering too early. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video, subscribe to Graph Insight, and let me know in the comments which concept you want me to break down next. I'll see you in the next video.